Hello and welcome to House Lux Estate, your trusted guide to mastering personal finance and living a luxurious life. We're here to help you navigate the intricate world of wealth, from understanding the basics of budgeting to exploring the nuances of investment strategies. Our mission is to empower you to take control of your financial future, enabling you to achieve the lifestyle you've always dreamed of. At House Lux Estate, we believe that financial knowledge is a key to unlocking a life of luxury and comfort. And it's not just about having money, it's about understanding how to make it work for you, how to grow and protect it. As we journey together, we'll share tools, strategies, and insights that will equip you to face any financial challenge that comes your way. Today, we're delving into a topic that's relevant and crucial for everyone: creating a personal finance plan that survives economic uncertainty. In an unpredictable world, having a robust personal finance plan is not just an option, it's a necessity. That's because a personal finance plan is like a roadmap for your money. It tells you where you are, where you're going, and how to get there. Without a plan, it's like driving in a strange city without a map or GPS. So let's talk about why a personal finance plan is so important. For starters, it gives you control over your money. A plan puts you in the driver's seat and not your bills or unexpected expenses. It allows you to make informed decisions about how to allocate your resources and helps you avoid overspending. But it's not just about control. A personal finance plan also gives you peace of mind. When you know what's coming in and what's going out, you can sleep a little easier at night. You don't have to worry about how you're going to pay for unexpected expenses or whether you'll have enough to retire one day. Now, consider the consequences of not having a personal finance plan. Without a plan, it's easy to fall into the trap of living paycheck to paycheck. You might find yourself in a cycle of debt, constantly borrowing to cover your expenses and then struggling to pay it back. And without a plan, it's harder to reach your financial goals, whether it's buying a house, starting a business, or retiring comfortably. Lastly, a robust personal finance plan can help you withstand economic uncertainty. We can't predict the future, but we can prepare for it. A plan helps you build an emergency fund for unexpected expenses, invest wisely for the long term, and ensure you have enough income to cover your needs. In a world where change is the only constant, a personal finance plan is your anchor. It provides stability and clarity in the midst of economic storms and gives you the confidence to navigate through financial challenges. Now that we know why it's essential, how about we get into the nuts and bolts of creating a personal finance plan? The first step in creating a personal finance plan is to thoroughly assess your current financial situation. To do this, we need to understand three key elements: income, expenses, and net worth. Let's start with income. This encompasses not just your regular paycheck, but also any additional earnings such as rental income, dividends from investments, or freelance work. Take the time to add up all your sources of income to get a comprehensive view of how much money is coming in each month. Next, let's talk about expenses. This includes everything from your rent or mortgage, utility bills, groceries, to your morning coffee. It's important to track every dollar you're spending. There are plenty of apps available to help you with this, or you could use the old school method of pen and paper. The key is to be thorough and honest with yourself. Lastly, your net worth. This is the total value of what you own, your assets, minus what you owe, your liabilities. Your assets might include your home, car, savings, and investments, while your liabilities could be your mortgage, car loan, or credit card debt. Calculating your net worth gives you a snapshot of your financial health. Remember, this assessment isn't about judgment. It's about understanding where you are right now, so you can plan for where you want to be in the future. Once you have a clear picture of your financial situation, you can move on to setting your financial goals. With a clear understanding of your financial situation, you can now set realistic and achievable financial goals. The first step is to establish short-term goals. These could be anything from paying off a credit card to saving up for a vacation. They're the stepping stones that lead to your larger, long-term goals. Next, consider your midterm goals. These might include things like buying a new car, paying for a wedding, or saving for a down payment on a house. They are typically goals that can be achieved in 2 to 5 years. Finally, it's time to think about your long-term goals. This could be saving for your children's college education, planning for retirement, or even building a dream home. Remember, all your goals should be SMART: specific, measurable, achievable, relevant, and time-bound. This approach ensures your goals are clear, trackable, realistic, meaningful to you, and have a set deadline. With your goals set, it's time to create a budget that helps you reach those goals. A budget is your financial roadmap guiding you towards your financial goals. It's more than just crunching numbers. It's about understanding where your money goes and making intentional choices about how to use it. So, how do you create a budget? It's simple. Start by tracking your expenses. Write down everything you spend money on in a month. Yes, even that daily latte or monthly magazine subscription. You might be surprised by how much you're spending on seemingly small items. Next, categorize your expenses. Typical categories might include housing, utilities, groceries, transportation, entertainment, and savings. Don't forget about those less frequent expenses like annual insurance premiums or holiday gifts. Now let's allocate your funds. A popular method is the 50-30-20 rule. It suggests that 50% of your income should go to necessities, 30% to wants, and 20% to savings. But remember, this is just a guideline. Adjust it to fit your unique circumstances and goals. Lastly, review and adjust your budget regularly. Your financial situation won't remain static, and neither should your budget. Maybe you got a raise, or perhaps your rent increased. Either way, your budget needs to reflect these changes. Creating a budget might seem daunting, but it's an essential tool for achieving financial stability. It gives you control over your money rather than letting your money control you. Now, armed with a budget, you're ready to tackle the next step, building an emergency fund. An emergency fund is your safety net during times of economic uncertainty. It's that buffer that stands between you and life's unexpected twists and turns. But why is it so crucial? Well, imagine for a moment you lose your job, your car breaks down, or you face a health crisis. These are all situations that can put a strain on your finances. An emergency fund can help you navigate these choppy waters without sinking into debt. So, how much should you set aside? Most financial experts recommend having at least 3 to 6 months' worth of living expenses saved up. But remember, this is not a hard and fast rule. Your personal situation may require you to save more or less. If you have a stable job, 3 months might be enough. But if you're self-employed or have a fluctuating income, you might want to aim for a larger safety net. Now, where should you keep these funds? You might be tempted to invest it, hoping to grow your savings. But an emergency fund should be easily accessible and safe from market volatility. A high-yield savings account is often a good choice. It offers a higher interest rate than a regular savings account and allows quick access to your money when you need it. Building an emergency fund might seem daunting, but every little bit counts. Start small and build gradually. With an emergency fund in place, you've built a personal finance plan that's ready to weather any economic storm. We've covered a lot today, so let's quickly recap. We kicked things off by underlining the significance of having a personal finance plan. Not only does it give you control over your financial situation, but it also equips you with the ability to handle economic uncertainties that may arise. We then moved on to the importance of assessing your financial situation. By examining your income, expenses, debts, and savings, you can gain a comprehensive understanding of your current financial standing. This understanding is the foundation upon which you can build a robust and resilient finance plan. Setting financial goals came next. Remember, these goals should be specific, measurable, attainable, relevant, and time-bound. Whether you're aiming to pay off debt, save for retirement, or buy a new home, setting clear and realistic goals will guide your financial decisions and keep you motivated. Then, we delved into the nitty-gritty of creating a budget. This is your financial blueprint, outlining where your money comes from, where it goes, and how much should be saved. A well-planned budget can help you live within your means and avoid unnecessary debt. Finally, we discussed the importance of building an emergency fund. This fund acts as your financial safety net, providing you with a cushion to weather any unexpected financial storms. Thank you for joining us on House Lux Estate today. Don't forget to subscribe and stay tuned for more practical tips on personal finance and living a luxurious life.